Is my overtime pay actually tax-exempt? The question of whether overtime pay is tax-exempt in the United States has a nuanced answer following the passage of the One Big Beautiful Bill Act in July 2025. While the phrase "no tax on overtime" has become a popular shorthand, it is technically a misnomer because overtime pay is not automatically exempt from all taxes. Instead, the law created a specific federal income tax deduction for qualified overtime compensation that applies to tax years 2025 through 2028. This means that while your employer will still withhold taxes from your paycheck as usual, you can claim a deduction when you file your annual tax return to lower your overall taxable income. It is important to realize that this break only applies to federal income tax, not to other mandatory obligations like Social Security or Medicare taxes. To qualify for this deduction, your overtime must meet several strict criteria defined by federal law. The deduction is specifically limited to overtime required under Section 7 of the Fair Labor Standards Act, which generally covers non-exempt employees working more than 40 hours in a single work week. Interestingly, the deduction does not apply to the entire amount of your overtime pay, but only to the premium portion, essentially the extra half of your time and a half earnings. For example, if your regular rate is $20 per hour and your overtime rate is $30, only the additional $10 per hour qualifies for the deduction. Furthermore, overtime required only by state laws or private union contracts that exceed Federal Fair Labor Standards Act standards may not be eligible for this federal tax benefit. There are also financial limits and income thresholds that determine exactly how much a taxpayer can benefit from these new rules. For the 2026 tax year, the maximum annual deduction is capped at $12,500 for individual filers and $25,000 for those who are married and filing jointly. This benefit is intended to support middle-income earners, so it begins to phase out once your modified adjusted gross income exceeds $150,000 for individuals or $300,000 for joint filers. If your income is significantly above these levels, the value of the deduction gradually decreases until it reaches zero. Additionally, taxpayers who use the married filing separately status are completely ineligible to claim this specific overtime deduction, regardless of their total income. Properly claiming the deduction requires specific documentation and reporting from your employer, which has become more standardized starting in 2026. While the IRS provided some flexibility during the 2025 transition year, employers are now generally required to report qualified overtime compensation as a separate line item on your Form W-2, often using a specific code like TT in Box 12. To receive the tax break, you must provide a valid Social Security number and file Schedule 1A along with your standard Form 1040. Because this law is currently set to expire at the end of 2028, it is a temporary provision that requires careful record-keeping to ensure you are maximizing your return. Keeping your own log of overtime hours worked can be a helpful way to verify that the figures reported by your employer accurately reflect your eligible premium pay. We welcome you to subscribe to our YouTube channel for more informative videos on taxes, finances, and investments. Thank you.